There have been two primary buyers of shares since 2009. One of them has been central banks. They continuously print money to buy shares as well as toxic assets, derivatives, and corporate debt. There is another group that in 2018 is projected to buy the most shares ever on record. But who could it be? You came here for the truth, so let me unveil that for you. Today we're going to look at the world's biggest buyer of stocks since 2009. Let's take a look. Cumulative net purchases of US corporate equities, you'll see that one group has amassed $3.3 trillion worth since March of 2009. And that is none other than non-financial corporates. And essentially what we are looking at are stock buybacks. This has been responsible for much of the gains that we have seen since the financial crisis. Even when you compare mutual funds and ETFs, which is the yellow line here, you'll see that it really doesn't compare to the quantity that have been repurchased by these different companies. Imagine you have these massive corporations that are sitting on piles of cash. And what do? Do they invest it? Research and development? They have been instead buying back their own shares. They've been doing it, as you can see, to the tune of over $3 trillion worth. It isn't necessarily the average investor. They don't really make a dent when you compare it to this group here. Now, obviously, central banks play a huge role in what's going on. But let us not forget about what the companies are doing themselves here. So let's look further into this in the video today. Companies over the past decade or so have significantly increased buybacks to the point where they are now collectively the largest single buyer of stocks. Some have called the market self-cannibalizing. Equity shrink is the nicer way to say that. So in this Bloomberg article here, they make some really good points and they solidify a lot of what I have tried to talk about over the past little while. So stay with me here for just a moment. I will cover this very quickly. Corporations are not particularly price sensitive. Buybacks tend to rise with the market, but they do try over short periods to buy the lowest average price. So in a long bull market like the one we are in now, corporations tend to step in and buy whenever there is a dip, which is what happened last week. Goldman Sachs said that their unit that buys here had a surge of orders last week. And so, check this out. All that buying insulates the market against drops, which causes volatility to drop. Lower volatility causes humans to think that stocks are safer and that computers will actually calculate that in. So think about the algorithms out there. They are seeing this and they are not really addressing the fact that it's stock buybacks causing this to happen. They are simply seeing it the way it is. Everyone piles into stocks, which lowers volatility further until there's a big blow off like last week. Stock buybacks are in effect creating low volatility. This is massive. It's absolutely massive to think about what has been happening with the share prices, with what we saw with volatility. It's a false idea that stocks are safe at this time, that there is no reason to worry, that there is no concern, volatility is down very low, and therefore stocks are safe. Let's pour our money in. And individuals are doing it, and of course companies are doing it too on all levels. But it's being thrown off from reality. If people had a real sense of risk, they wouldn't be investing in this way, and even companies wouldn't be investing in this way. But they're trying to get some yield, and that's the ultimate goal here. They want a return. They want a return on investment, so they need to take risk. That's what's happening. You can definitely see that it is very clear in this instance. So let's move further along. Look at this. Announced buybacks year to date period. You'll see here that over this period of time, we have seen an increase. Depends on the year, depends on the situation, of course. But we are projected in 2018 to see the biggest share buybacks we've ever seen. You can see this. According to Goldman Sachs, their estimates here, $690 billion worth in a year. That would be insane. Total capital expenditures that they're using here, share buybacks, 650, it looks like what they're stating. But anyway, it doesn't matter. You're seeing massive numbers, the biggest ever. And they really should be telling us something, that these companies are sitting on the most massive piles of cash that it's unimaginable. And so what do? I mean, they could be investing this back into their businesses. They could be using it productively. They could be paying that back to the investors somehow. They could be engaging in something that would be beneficial to the economy. And what do? They buy back their own shares, distorting the markets even further. There are two reasons why volatility, you've seen it go lower and lower. One was covered here in the video, and that is because of share buybacks. And number two, we have the admissions of the Federal Reserve saying that they have a short position on volatility. That's all we need. We have their own admissions, and they don't even care. The biggest game in town. Over the past few years, corporations have become the largest buyers of stocks, spending on buybacks by companies in the S&P 500. Okay, so we're seeing the same level of information here. It's not surprising to see that companies will do whatever it takes to, fill their bottom line to make that happen. They have to worry about corporate profits. I understand where they're coming from. If you're working in this role here and your superior is telling you that you need to ensure that corporate profits are always rising, you're going to do what it takes. You're going to sit down at those board meetings, you're going to tell the different presidents, and they'll tell the different directors and so on, and it just goes down the line. There's a compartmentalization that exists, and everyone has to do their job. They don't really understand the bigger picture. They don't know what's happening. All they know is they have to do their job so they can get their salary, so they can, deal with their own situation. I understand that, but we can look at it, what I like to call zooming out, and really get a good perspective of why this is happening, how it's happening. Now, I thought this was very interesting. The buybacks index compared with the VIX. Now, of course, the buybacks index, it's an inverse here, looking at this. But it seems to be tracking it quite accurately, actually. Over time, we can see that these are both declining at quite a correlated pace, I would say. As the VIX declines, the buyback index inverse is declining as well. So buybacks, as far as I'm concerned, are very clear. It's very evident that they are really pushing volatility downward. Of course, you can't necessarily keep this up forever. It's going to have to pop at some point. We saw just that little bit of fear and the market freaked out. So one day it's going to have to really escalate. And this is more of the same here. Quarterly share repurchases and the number of companies repurchasing shares. I thought it was interesting. Wanted to mention it here. Companies repurchasing shares. So not just the total quantity, because you could have a company like, let's say, Apple, and that makes up the largest percentage here. But we are actually seeing, on average, the more companies that have been buying back shares. It's important to note. And when you look at this as a whole, you're seeing that it's not just one or two or three companies. You're seeing that it's many. And they're buying back massive quantities, as I said here. to the tune in 2018 that will be record breaking. So remember, to conclude here for this video, that we are seeing volatility decline for two major reasons. One is that there are share repurchases, and that you are also seeing the Fed's admissions of shorting volatility. That's huge. Now we have two major reasons why stocks have continued to increase. Number one, of course, there are share buybacks. They're pushing up the market. Number two, the Federal Reserve, the central banks around the world are printing money. They're buying shares. That's all you need to know. You have the proof. You have the evidence. You have all of the details, the indicators, the admissions, the 13F filings of all of these different companies and everything that happens. A lot of it is public. And so you don't need to speculate. You don't need to worry about anything like this. All you need to know is to look at the truth and realize what has been happening. So I'll end it there for this video. If you found it informative, please give me a thumbs up. Remember that you generally don't find this kind of information elsewhere, at least in this detail, and I try to empower everybody to then go off, do your own research. You don't need to know what's happening with myself. What you need to know is how to be able to analyze the data that I'm showing you here and piece it together for yourself and make your best judgments. So that's all. I will just say that if you found the video informative, I know you'll find my books, The Money GPS and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. Go over to Amazon. Links are in the description. You'll be able to flip through the pages of these books to see if you like them. Take care.